Welcome to this personal tax roundup for this month. My name is Dean Wootton. This year we're going to look at the spring statement. There wasn't a lot in the spring statement, but what there was is worth a quick mention. Now, the basic rate of income tax will reduce to 19%, so from 20 to 19%, with effect from April 2024. Now, that rate will apply to the basic rate of non-savings, non-dividend income for taxpayers in England, Wales and Northern Ireland, as well as the UK savings basic rate and default basic rate for trustees and non-residents. There's going to be a 3-year transitional period that will be in place to allow charities to transition from a 20% repayment on their gift aid to a 19% repayment. There's no changes to the health and social care levy, so that's all coming in as planned from April 2022. That's on the national insurance, 1.25 on national insurance, and also 1.25 on the dividend rates. Now, there are some welcome changes to national insurance. The primary threshold for Class 1 NIC and the lower profit limit for Class 4 NIC is going to be aligned with the personal allowance from the 6th of July 2022. So that'll be £12,570. Now, it only applies from the 6th of July 22, so for this first year, 22-23, it'll apply from month 4, beginning of month 4 for employees, and the self-employed are going to get a pro rata limit for 22-23 of 11,908. That's 13 weeks at the old 9,880 and 39 weeks at the new 12,570. Obviously, when we go through to 23-24, we'll have the whole 12,570 for the full tax year for employees and the self-employed. Now, from April 22, self-employed individuals with profits between the small profits threshold and the lower profits limit will be able to build up NI credits without having to pay any Class 2 national insurance. So a very similar principle that we originally had for Class 4, where you have effectively a contribution history for things like state pension, etc., even though you're not paying any national insurance. So the self-employed are going to have the same benefit as, say, the employed have had for quite some time, once their profit levels exceed those lower levels. Now, the employment allowance, that's the national insurance, the employer's national insurance allowance, it was £4,000 per annum for 21-22. It will be £5,000 per annum for 22-23. That's the employer's allowance, i.e. the first £5,000 of employer's national insurance they will not pay in April 22, provided, of course, they meet the conditions, so more than one person generating an employer's national insurance liability. There are some capital allowance changes under consideration. They're thinking of increasing the permanent level of the annual investment allowance to £500,000. It's been temporarily £1 million for a few years now, but it's due to go down in 2023. But they're considering a permanent level at the £500,000 mark. They're looking at increasing the write and down allowance from 18% to 20% for main rate expenditure and from 6% to 8% for special rate pools. They're looking at introducing a first-year allowance for main rate and special rate pools. They're thinking of 40 and 13%, but it's all up in the air at the moment. They're thinking of introducing an additional first-year allowance to bring the actual relief to more than 100%, a little bit like the super deduction that we've currently got. And maybe, and I think this is a very loose maybe, introduce full expensing to allow businesses to write off the cost of investments in one go. I'd be surprised if that came in. There's also some subtle changes to research and development relief, and these take place from April 23. Now, from that date, all cloud computing costs, including storage, will qualify for R&D relief, as will pure mathematics. Now, they were thinking of restricting R&D spend to UK activities, but they realised that some R&D has to be incurred overseas. So overseas activities will continue to qualify for relief, where there are material factors such as geography, environment, population or other conditions that are not present in the UK and are required for the research, so they have to be done overseas effectively. Or where there are regulatory or other legal requirements that activities must take place outside the UK. Now, the government are also considering whether to increase the research and development credit for large companies to boost investment in the UK. The business rates multiplier is going to be frozen in 22-23. There's also a new temporary 50% business rate relief for eligible retail, hospitality and leisure businesses. We've also got targeted business rate exemptions being brought forward. They were originally from April 23, they're now from April 22, and they're going to last right the way through to the 31st of March 2035. The VAT changes, only one of those. The VAT 5% rate on the supply and fit of energy-saving materials will be reduced to zero rate, i.e. naught, from April 22. And the number of items that qualify for the relief will also be extended. This is a direct result of Brexit. We are not bound by what we can zero rate. So the government can zero rate this if they want to, and indeed they have done. Now, there's also a temporary 12-month cut in fuel duty, as we're all aware, of 5p per litre. And that's pretty much the spring statement. Not a lot in it, but worth a mention because there is some quite important stuff in it. Let's now look at a case concerning residency and whether capital gains and income was payable. Now, John Hargreaves was the Mataland executive chairman, and he left the UK to live in Monaco. He did, however, continue to spend a lot of time in the UK and own a property in the UK for his use. Now, he thought he was non-resident for 2000 and 2001, so his tax return did not include the sale of his Mataland shares for £231 million and his investment and employment income of £5.6 million. There was no CGT supplementary page submitted with his return. All he put on his return was a white space entry stating that he was non-resident. Now, in January 2007, following various newspaper articles, HMRC raised a discovery assessment to collect some £84 million worth of tax. Now, John Hargreaves appealed to the First Tier Tribunal initially on two grounds. First was that in 2000 and 2001 he's not liable to income tax or CGT as he was neither UK resident or ordinarily resident. And secondly, HMRC's discovery assessments were invalid. They started looking at this in 2003 and it didn't get around until 2007 before they actually raised a discovery assessment. Now, this went up to the First Tier, and prior to the hearing, John Hargreaves accepted that he was actually a UK resident in 2000-2001. I presume the facts couldn't say any different, so he accepted that. Now, the First Tier Tribunal allowed the appeal, but they ruled that the discovery was stale. It took them from starting looking in 2003 until 2007 before they raised the assessment. Now, they went on to say if it wasn't stale, then the return had not been made in accordance with the practice prevailing at the time, and HMRC had not been given enough information to be aware of the insufficiency. HMRC appealed the decision that the assessment had become stale, and Mr Hargreaves appealed the decision, arguing that if discovery was not stale, HMRC had the required information, i.e. the white space entry stating that he was non-resident. Now, up to the upper tribunal it went. Now, both parties agreed that the appeal must be allowed, given the subsequent decision in HMRC and Tooth. This decision was made after the First Tier's original decision in this case. As it all boiled down to whether there was enough information to enable HMRC to think that there was an under-declaration. Now, with no CGT pages submitted, a hypothetical officer could not have known of the game. HMRC did not have the required information, so the assessment wasn't stale and they didn't have the required information. A white space entry saying I'm non-resident is not going to be sufficient for them to know that there's a thumping great gain and income which is not being reported. So unfortunately for Mr Hargreaves, his case was dismissed. We're next going to look at gifts to charity and the ability to claim relief on those gifts. Now, 5 individuals made gifts of shares in Task Catch plc to a charity. Now, these individuals claim tax relief on the value of the gifted shares at their dates of each gift. Now, they argue the value should be based on information publicly available at the time. So a valuation of between 32.5p and 40p was based on 4 very small trades registered on the AIM market and the values given when new shares were issued. Now, HMRC said that these values were significantly overstated, so their gift relief claims are too high. HMRC argued that you should consider other factors, so values used when acquiring another company. I think 7p was bandied around about that time. Projected revenue, performance of similar companies. Now, the individuals obviously didn't agree, and they appealed to the first-tier tribunal. Now, joint reports set out agreements and disagreements on what was publicly available. It was agreed to disregard unpublished and confidential information. Fair enough. It was also agreed that the market price of thinly traded shares may not accurately reflect the open market value of the shares. It did seem that the fundamental basis for the valuation of these shares was on some very small trades on the AIM. However, the individual's expert valuer did not take into account all of the publicly announced transactions. They did focus on the most recent small AIM trades, as I said, and there was no weight given to the significant acquisition of Skylark round about a time when it was agreed the price was 7p per share. Now, a prudent purchaser would have looked at more than just some recent tradings on the AIM market. They would have looked at other publicly available information. HMRC's lower valuations were therefore appropriate, and gifts should be valued at a midpoint of HMRC's values of between 8.85p and 6.25p per share, so significantly different from what the taxpayers were claiming. It's worth noting that since December 2009, i.e. after this one, there is an anti-avoidance provision, which means that if the donor has held shares for at least 4 years, which would have been the case in this instance, then use the acquisition cost rather than the market value for the value of the gift, where it's part of a scheme where the main purpose is to obtain relief. Well, let's now consider quite an interesting case on PPR, and it concerns a Mr. Mark Campbell. In 2017, HMRC asked Mark Campbell to submit a self-assessment return for 15/16. He did so, and on that return, he reported the disposal of a bungalow, claiming that this was the only property he owned, and that it was job-related accommodation, as he lived with his parents as his father's carer. Now, it subsequently transpired that Mark Campbell had actually bought and sold 4 properties over 5 years. Each needed to be refurbished and was left empty while the work was undertaken. All 4 properties were sold at a profit. Now, Mark Campbell argued that he had intended to live in each property as his main residence, and he gave various reasons why he didn't actually live in any of the properties. Now, HMRC issued a closure notice for 15/16 for £131,000 and 2 discovery assessments for earlier years of £100,000. They argued initially that he had been trading and so was liable to income tax. Now, on the appeal, HMRC argued that if he wasn't trading, then he was liable to capital gains tax, but there would be no PPR relief because he never lived in any of them. Now, First Tier looked at this and they said, well, this chap's been very active in the property market. There's no evidence that he actually intended to live in any of the 4 properties. He was not a property developer, but rather these were capital transactions. Living with his parents due to his father's illness, that's not job-related accommodation, i.e. a reason for not living in the property. There was no evidence showing any degree of permanence, continuity or expectation of continuity in relation to any of the properties. So the First Tier thought the profits the individual was making, Mr. Campbell was making, were gains, and those gains were not subject to principal private residence relief, so they were taxable in full. HMRC's penalties for deliberate behaviour, totalling some £40,000, were upheld. He had failed to declare the property sales, and he should have known that this rapid buy, do up, sell should have had tax implications. Now, I find this case quite interesting in many respects because it does look like a trader. He's buying property to do up, sell it on at a profit. And you'd think HMRC would have a good shot at establishing trading. But even though he had 4 properties in 5 years, the First Tier still held that it was capital. Now, the capital rates are obviously much lower than the income rates, because the maximum rate for this for capital gains tax will be 28, whereas for income tax you're probably looking at 40%, maybe 45% in some situations. So it's good that he got capital, but unfortunate that he didn't get PPR. There's no chance for getting PPR on this one because he never lived in them, couldn't prove that he ever intended to live in them, so no PPR on those. But he got capital rather than trading. Capital is lower rates. All right, we've got a rather unfortunate situation for the rulings. Now, the rulings were both UK tax resident taxpayers. And in July 2006, they jointly bought a property in Switzerland for 563,000 Swiss francs. And this was partly funded by a Swiss franc mortgage. Now, in December 16, the property sold for 730,000 Swiss francs. Now, they each declared 50% of the total gain, and they calculated that to be £39,000. And this was arrived at by deducting various expenses, including the mortgage repaid. Now, HMRC opened an in-time inquiry and recalculated the gain at £267,000. They disallowed all costs in connection with the mortgage, understandably. Now, HMRC's calculation translated the proceeds and related fees into sterling using the exchange rate in 2016 when the property was sold, and they deducted costs using the exchange rate applicable in 2006 when the property was bought. And because they're using different exchange rates, it produced this really high gain, and just because of the movement in the exchange rate. Now, HMRC issued a closure notice in respect of Howard Rawlings' share of the gain and a discovery assessment in respect of Monique's share. They also issued carelessness penalties based on 15% of the tax charged, having given full mitigation. Now, the Rawlings argue that HMRC's gain was artificially increased by the currency rate fluctuations, which it was. And the reason they were, I presume, offsetting the mortgage is because they were getting hit by the exchange rate on their cost versus proceeds, but actually they were funding it via a mortgage. So therefore, they were kind of thinking, well, surely we should get the benefit of the liability going the other way as well. Now, that's not actually how capital gains works. The capital gains are calculated in a very logical, mechanistic way, and that was followed by HMRC. The gain had been correctly calculated. Even though the exchange rate movements had severely affected the resulting gain, the gain was correct. Nothing to do with the mortgage was deductible. And you get this quite a lot with these exchange movements because on paper they might have made quite a big gain. In reality, they haven't. Because what they've done is they've just used the money effectively to pay off the mortgage. So actually they're not bringing back all that money into the UK. They're using a lot of it to pay off the mortgage. So therefore, in their mind, they've made this big gain, but in tax law they have. So unfortunately, even though it might seem unfair, the appeal was dismissed. Now, the Office of Tax Simplification have stated the government should consider whether gains or loss on foreign assets should be calculated in the relevant foreign currency and then converted into sterling. So you work out the gain in Swiss francs, for example, and then you convert the gain at the sale date. And that would, to me, seem far more sensible. It definitely would avoid situations like this. But it's only a suggestion. It does bring the position into line with treatment of foreign currency bank accounts, where taxpayers are not taxed on currency gains. Effectively, for capital gains, they are taxed on movements in currency, as this couple found out. A case on stamp duty land tax, or two cases actually, and this is a Court of Appeal decision, and they were looking at two upper tribunal cases. Now, taxpayers argued they had bought mixed-use property, therefore the residential rates were not applicable. The commercial SDLT rates are lower than residential SDLT rates, so they were trying to get the commercial rates, i.e. the mixed-use rates. Now, in the Hyman case, a house is bought with 3.5 acres of land, including a rundown barn and a meadow. And the Hymans argued that the barn and the meadow meant that this was a mixed-use property. In the Goodfellow case, a house and 4.5 acres of land was bought with a garage, office, stables, paddocks. Now, the Goodfellows argued that the garage, office, stables and paddocks were not residential property, i.e. it made it a mixed-use property. Now, the definition of residential is within Section 116 of the Finance Act 2003, and this states that the land forming part of the gardens or grounds is residential property, with SDLT payable at residential rates. Now, in both cases, the taxpayers argue the land did not form part of the garden or grounds. It was not needed for reasonable enjoyment of the dwelling, and the purchase should therefore be treated as mixed-use property taxable at the lower SDLT rates. They're kind of using the PPR tests for capital gains tax and saying, well, we don't need it for reasonable enjoyment, so therefore it can't be part of the residential property. We bought more than just the residential property, so the extra bit as well, and therefore that's mixed-use properties. Now, the first tier and the upper tribunals disagreed, and these cases were heard jointly by the Court of Appeal. Now, the taxpayers can only rely on statute. Other documents can assist with the understanding, but they only play a secondary role when interpreting the law. Now, the guidance relief related to stamp duty, not stamp duty land tax, which is what they're looking at, and the words in the SDLT legislation were clear and unambiguous. And it's all within that Section 116 Finance Act 2003. And that's where you have this classification of residential versus non-residential. Simply including significant amounts of land does not make the property mixed use. So therefore, unfortunately, they bought property with lots of land, but the fact it's got lots of land doesn't make it mixed use. So unfortunately for them, the appeals were dismissed. Well, that concludes the personal tax roundup for this month. My name is Dean Wootton. Thank you for listening.